Welcome everyone to Tabor Institute's webinar, Project Risk Management in the Oil and Gas Industry, Why Now? This is a rebroadcast of the original webinar, which was shown on April 25th. If you're unfamiliar with Tabor Institute or Risky Project software, brief introduction. We show our timeline. We were established 2002. 2014 we released our last major version, version 6. Risky Project is a full suite of project risk analysis and management software with 2 desktop versions, a light and a professional version, as well as an enterprise, which is a project portfolio risk analysis and management, and Risky Project Cloud, which is a qualitative risk management tool. On the right, just a brief view of some of our clients. We do have quite a few oil and gas clients, as well as we work with many project consulting groups that specialize in project risk management in the oil and gas sector. The information that we're going to be looking at today to frame the situation that we see has been provided to us by one of our consulting partners, but is also publicly available. So, 30-year overview of the underlying oil and gas prices or oil prices. What we can see is there is a lot of variance. What does that mean is that we can't really tell what's going to happen next. However, what we do know is that experts within the oil industry believe that prices will remain within the $50 to $80 range for the next few years. Why is this significant? Well, a large portion of North American production break-even costs are above $60. So break-even costs around the globe, all the producing regions. A couple things we can take away from this. One is that there's even though there's a lot of variance across the globe based on the different areas, there's a lot of variance within each producing region. And the difference are obviously geophysical, geotechnical, but a lot of times the differences in costs, some of it can be attributed to the management processes of the various companies involved. Some companies are able to reduce costs in the face consistently, as opposed to their competitors, and remain more profitable. One of the other things we can see is that North American production tends to be the variance, especially in the shale, is quite low, and we think that's because of some technical efficiencies that have come out lately. The other thing is that we can see that if oil remains at $60 a barrel, where it is about right now, a lot of North American production will remain profitable. However, if it goes down and stays around $50 for an extended period of time, pretty well all of our conventional up to unconventional oil sands production will have to make efforts to control and reduce costs in order to remain profitable. So break-even cost components, you can see this is an illustrative example: contingency, differential, cost of capital, planned versus actuals. If risks occurred and they're not managed properly, it will greatly escalate the break-even cost and cause projects either have a lower ROI or be postponed or shut down. If we put in a robust project portfolio risk management capability, we can actively manage those risks and reduce the overall impact and bring down that cost, and therefore in periods where we have these depressed oil prices, we can remain profitable. One of the examples that we have seen lately, Harvest Energy's Black Oil Sands project, they took a risky project plan to develop 2 phases at the same time, probably because they saw the opportunity for some economies of scale. However, it did not work out, and it turned out that the threats in that plan were greater than the opportunities, which they probably didn't anticipate. Costs escalated during the construction of these 2 phases, went over $60 a barrel, and that project has now been postponed. So that's a fairly striking example of what we see can happen. Quickly, we're going to take a look at some of the break-even costs at some North American fields. We have different producers operating in different areas. One of the things that we do see is that there's a considerable range. Eagle tight oil, the Bakken, a little less variance, the oil sands. There's variance, and that variance can be, again, because geophysical, geotechnical, other things, but a lot of it is that some companies, some producers, because of management capabilities and management practices, are consistently able to keep their costs lower. Now, where does that come from? Well, from the Wood Mackenzie report, next year they're expecting to see a 33% reduction in exploration costs. Obviously, some of that's going to be coming from the reduction in the cost of labor and material resources. However, they're also pointing out a significant portion of that is going to be efficiency improvements. Now, what do efficiency improvements mean? Efficiency improvements take in management and technical. And on the management side, one of the overarching practices or disciplines is risk management. Risk management overall oversees all these other areas of practice: supply chain management, procurement, project, cost engineering, human resource and communication management, etc., etc. Risk management oversees all of it, and it's one of the most, I'm going to say, the most effective and cost-effective ways of accelerating projects and minimizing costs. So if we can ensure that we have a solid risk management process in place that's being applied consistently and comprehensively across all of your projects, you should be able to affect some significant cost reduction. In this environment, it could be up to $1 a barrel based on what Wood Mackenzie is saying, and that could mean the difference between profitability and loss. So when we look at that, we want to, when we're going to go in and assess our projects, we want to create or import a project plan. We want to identify project risks. We want to assign the risk to the projects and activities and calculate the impact of these risks on the project. We want to assess the impact of the risks on the project and the portfolio, and we want to create risk response plans and manage the risk during the course of the project. So it's fairly straightforward and probably not unfamiliar to most people. Now, what does that look like in risky project enterprise? So what we have here is a simple example of a oil and gas project portfolio. Each one of these is a project, and what we want to be able to answer is a couple questions. What risks and uncertainties do each project face? What impact will they have on our project costs and schedule and other impacts? And how will that affect our project portfolio? So as we assess the risks at the project level and we roll them up, how does it affect the portfolio? Do we have some projects that have become so risky that we're not that their priority is going to go down? We're not going to develop them at this time, or we're going to postpone them until such a time that we're able to get a better handle on that. So we want to be able to go through this process and understand how these risks are going to impact, manage them, and then go forward and put together planning and development plan at the portfolio level. So how does this look? Well, one of the things we want to get our project plan into the system. So what does a project look like? Well, it has a schedule with activities, and we have, you can see we have some uncertainties there. We have resources, and resources will have rates. I'll just drag this over to show that. And there we can see the rates. So we can do time-dependent costs. Cost and income, so fixed costs. And fixed costs, again, as part of that, they can be risks, or they can have have uncertainties around them. So we have fixed costs associated with all of these activities. Now a project also, each project has its own risk register. And risks, we can see we've identified risks. And in this case, we've assigned them to some activities, and it gives us their probability of occurring and their impact and overall risk score. So how do we assign these? So now we've identified a risk, but we haven't assigned it yet. So we have it right here. So what we do in Risky Project, we can drag and drop them. So I'm going to select 3 major summary activities and have these activities below. And in this way, I can quickly drag this risk across. I can give it a chance of occurring. Let's say it's a very, very high chance of occurring. And we can assign the impacts, which we call outcomes. And in here, I'm just going to give it a triangular. And I'll say 10. And we will say there's also going to be an impact on cost, on the fixed cost, and we'll say there's a relative, and we'll give it a triangular, and we'll say that goes from 2 to 5 to, and we'll say 10. And we can also assign other impacts that are non-schedule, non-cost. Could be things like reputational, could be safety. Ooh. Well, so there we go, minor and minor. Oh, doesn't like that. And we can say, we'll also give it a quality. And therefore we've now assigned it, and we've assigned not only the cost and schedule, but other sort of risk impacts that we'd like to have in our risk register. We click that, and if we now take a look at the risk register, we take a look and we can see how that's been assigned. We can now calculate. Now the next step in that, we can see now that it's dropped up. We want to take a look at how this is going to impact our project. We can see now this is the result Gantt. We can see because of risk and uncertainties in the system that the project is sliding to the right. In the project summary, we get to see all of our charts. If we wanted to, we can see all of the data associated with that, statistics, percentiles. It gives us an overall feel for what the uncertainty in the system. At the very high level, we get the different values in our original versus our risk, so P10 versus P50 and P90. And we can see here that we have approximately almost $4 million worth of risk in the system. From the original estimate. We can also take a look at the cost analysis, and because the project is running longer and we have a mostly time-dependent cost in here, it's going to cost more. Now, what does this look like at the at the portfolio level? How does it affect our portfolio? So we can just going to close this. It'll take a little while just to save to the database the new results. And then we're going to take a look at what we call our project portfolio. We can see, again, it's going to show us our estimates for duration. It's a risk score. We can see our risk score for cost. We have what's called a risk projects. Now, risk projects is a view, a bubble chart that shows the relative risk in the projects. It's a very good way of pinpointing or identifying projects which have more relative risk in accordance with the amount of costs, base costs or base schedule they have. We can look at it at project cost or duration, and we can see right here that we do have a couple projects here that have a lot of costs associated with them. Now, once we've looked at this higher level at the project portfolio identified, we want to take a look at which risks are perhaps driving these results that we're seeing. So we can now take a look at the project risk portfolio risk register, and we can see that that risk that we had, which is the highest on that project, is also the highest on this at the portfolio level. And if we want to open that up and take a look at that, we can see how that's been assigned across the portfolio. And we want to be able to put some planning around that. And because it's our most critical risk, we want to put some plans in place to manage that risk, to bring it down the impact. And so what we can do at that point, and this is one of the first places, we'll put what is the cost of that risk. And so we can say that risk is represents $1 million at the portfolio level to our portfolio. We can see what the expected value of that. Now, once we've done that, we can go to mitigation chart, and we can start to put in some plans. And what we do is have some generic examples, but we can put in some activities. Now, the activities risk, which represent when they will occur, when they should be completed, how they will reduce probabilities, so it'll take it down from there down to 30%, how it might reduce impact, and the cost of that. And what we get is a waterfall chart about how we propose to manage that risk and bring it down to an acceptable or within our tolerance. And we can see here the pre and post mitigation cubes, and we can see how it's brought down, and we can see the total cost of that. And so when we go back to the properties, we can see how that rolls out in here. Just going to change that because we brought it down to 50%. Now, so we can see that the expected loss now is $50,000, and we're going to bring that. The cost of the risk now is the $75,000 from the mitigation, and here overall it's going to cost us, we believe the expected value of that residual risk is $125,000, and we're expecting to save, we'll reduce our break-even costs by $627,000. So a significant portion of that. If we can do this to all of our risks, click OK, and we can take a look at the risk matrix. So this is looking a bit busy here, and we'll just simplify this a bit. And we can start to plan about our risks and see where the pre and post mitigation of those risks are. And if we can bring that into the system, assess up front, manage them during the project, make sure we can control them, we believe that will have a significant impact on the overall break-even cost. So if we can reduce that break-even cost by even $1 in this period of where we have reduced prices on the oil, that can be significant tool in your toolkit for impacting the overall profitability and feasibility of your projects. So in closing, if you'd like to know anything more about Risky Project Enterprise or any of the other applications mentioned in the presentation, or if you have any questions, please feel free to contact me, Michael Trumper, at Endeavour Institute. My contact details. Please visit our website. We have many white papers and articles. We have some tutorials. We also have a couple, 2 books that have been published. Project Think was published in 2014 and won the David Cleland PMI Literature Award. So thank you very much for your time, and we look forward to hearing from you.